Lesson number 7, commodity and currency futures pricing. As I already told you in the previous lessons, futures written on a commodity and the futures written on a currency follow different logics than futures written on stocks. So here what you will learn in this lesson: how to calculate a commodity futures price, why it is not just a matter of time and interests this time, contango and backwardation, and currency futures. In the case of physical goods, such as cereals, metals, or oil, just to say, the various exchanges on which futures on such assets can be traded have warehouses in which to store the goods that the buyers and the sellers of futures exchange. Storage is a cost that must be somehow included in the futures price. Transport, on the other hand, is not included in the futures price and cannot be included because it's a very variable cost. For all intents and purposes, storage costs act as negative dividends. Therefore, their current value must be added to the spot price. If you remember, in the last lesson, we saw that when a stock pays a dividend, the current value of the dividend needs to be cut from the spot price in order to achieve the correct futures price. In this case, we have to add something because we have an extra cost due to the storing of the good. So for all intents and purposes, once again, storage costs act as negative dividends. Therefore, their current value must be added to the spot price. And the value thus obtained must be capitalized at the current interest rate based on the residual life. Being X the current value of storage costs, then the futures price is equal to spot plus X times exponential power 2 interest rate times time. Let's see an example. Suppose the price of a barrel of physical oil is $90 and the storage costs are $5 a barrel per year. Calculate the futures price with the 3-month maturity given a risk-free rate of 2%. The quarterly storage cost is $1.25, $5 for a barrel per year divided by 4 quarters. And the present value of this cost is then the following: X equal to 1.25 times exponential power 2 minus, because we are discounting backwards, minus 2% times a quarter, 90 divided by 365. It's the same, more or less. And the result is 1.243766. The futures price is then futures equal to spot price $90 plus the present value of storage costs, 1.243766, times exponential power 2 plus 2% this time, because we are capitalizing onward, times a quarter of a year. The result is $91.70. But to discuss the validity of this formula, we need to introduce some new concepts. What does not appear in the previous formula are the dynamics that act on supply and demand, which can misalign the futures price between the various maturities according to various events. The futures price on goods actually depends in a consistent way on the expected quantity produced, the expected consumption, and the possibility that by a certain date, atmospheric or other events occur such as to misalign the reality with respect to expectations, and the like. These factors bring the futures price does not respect simple mathematical formulas. Ultimately, it is the market that makes the price, based on what it knows and what it expects for the future. An interesting element concerns the dynamics of prices between the various maturities in function of contingent events that act directly on the nearest deadlines and are neglected by those more distant. And soon we will see a couple examples. In normal situations, read it when supply and demand are not influenced by particular events, so they are more or less balanced, the more distant maturities quote higher prices than the near ones because they capitalize the spot price, the interest rate, and the storage costs over a longer period of time. This natural situation is called contango. But the balance between supply and demand can be misaligned, and it can be misaligned in two directions with diametrically opposite effects. When there is a strong excess of immediate supply with respect to the expected future demand, there is an amplification of the contango. Think of what could happen at the end of an unusually mild winter. Oil producers could find themselves with quantities of barrels ready for sale greater than expected. Demand is falling because it goes towards the warm season, so prices fall compared to those that will occur in the autumn in view of the following winter. The futures price on shorter maturities is much lower than that on the distant ones. In some cases, however, the inverted relationship called backwardation may also manifest itself. In backwardation, the futures price on shorter maturities is higher than that on distant maturities. And similar situations occur, for example, when in the midst of an unexpectedly very cold winter, the oil reserves accumulated in the autumn on the basis of the weather forecasts decrease faster than expected, and an immediate need for further supplies appears. Buyers need the physical good now, so they are willing to pay more in order to get it right away. And the short futures price rises and becomes even greater than the medium and long-term price. What about currency futures? In the case of exchange rates between two currencies, there are two interest rates to be taken into account when calculating the futures price, the rates of the two individual countries. The pricing dynamics in this case must be such as to neutralize the possibility of obtaining extra returns by moving capital from one currency to another to benefit from higher interest rates in one country or another, thus making the two investments equivalent. From a mathematical point of view, the aforementioned need is solved by capitalizing the spot exchange rate on the differential between the two countries' rates, according to a specific order. The formula is as follows. The futures price is equal to the spot price times the exponential power to the difference between the internal rate of return and the foreign rate of the return times the time to maturity. The internal rate is that of the currency in the denominator of the exchange rate. The foreign rate is that of the currency in the numerator. Let's look at an example. B1.0675, the euro spot exchange rate against dollar. This is the forex exchange rate, the real exchange rate between the two currencies. Euro is in the numerator, dollar is in the denominator. How many dollars you get for 1 euro? 1.0675. B 0.5% the American interest rate, 0.1 the European interest rate, and 1 year the remaining life. Here the American and the European interest rates are on the basis of a 1-year government bond. The futures price is then equal to 1.0675, the forex exchange rate, times exponential power to the internal rate of return, the rate of interest of the currency in the denominator, 0.5 US dollars, minus the interest rate in the euro zone, 0.1, times a year, 1. And this leads to 1.071779. Is this futures price correct or not? Why is the futures price, and has to be, in this case, higher than the spot price? The answer is that if I am a European citizen, I have a current account in euros, and I go to buy European bonds, I expect to collect 0.1% interest. If I look at the American market and see that it makes 0.50, I can change my euros into dollars and buy American bonds, collecting 0.50. But obviously, I am exposed to currency risk, so I have to cover this risk so as not to see myself potentially eroded the advantage of a greater interest from a currency loss. For the coverage, I can go to the futures market and use a small amount of money, postponing the use of the money equal to the value of the contract to a certain future date. In doing so, if the futures exchange rate is equal to the spot, I am going to benefit from a higher expected return at zero cost. This cannot happen, of course. If, on the other hand, the futures price is higher than the spot, then the advantage of the greater American interest rate is neutralized in part or totally by the cost of the hedge. If this cost is exactly equal to the yield differential between the two countries, I have perfectly neutralized the advantage, thus making the buying of European or American bonds indifferent. And once again, it is all about neutralizing arbitrage opportunities. Let's see all of this in numbers because it's much easier to understand. Suppose we have 100,000 euros at the start and we want to invest them in full on American bonds. The conversion of euros into dollars gives us 106,750 US dollars, which are invested at 0.50% on an annual basis. The investment then becomes, at the end of the year, of course, final value of the US bond, 106,750 times 1 plus 0.50%, or 1.005. It makes 107,283.75 US dollars. And then, at the end of the year, we can convert this money amount back into euros. And what do we get? It depends on the exchange rate. By converting this value into euros at the same initial exchange rate, we would have 100,500. 107,283.75 divided by 1.0675. Basically, if this happened, I would keep all the advantage of the American bond without having to worry about the exchange rate between the two currencies, because I purchased a futures giving me the right in 1 year to convert back US dollars into euros at the initial exchange rate. If, on the other hand, I bought the futures on the exchange rate at the price calculated in slide 56, the final value in euro would be equal to 107,283.75 divided by 1.071779, the futures price. It would make 100,100 euros. In essence, I brought back the performance of the American bond at exactly the same level as that of the European bond, thus neutralizing the arbitrage opportunity. This concludes the first part, the part about futures. I hope I was able to make all the concepts clear, but once again, should you have any doubt or question and you want to contact me, feel free to email me to info@quantoptions.it. Thank you for your attention.